Hello and welcome to the portfolio management material. I remember back in the old days when portfolio management was sort of a pushover. I think you'll find that this material is not particularly easy as you work through the portfolio management at level 2. So be ready for some excitement. There's lots of formulas, some concepts, those types of things, a little bit esoteric at a few points, but overall it is manageable. It's something that you can get down, and it is infinitely testable, so it's something that you're going to want to spend some time with. We have several readings to tackle here. Let's jump in first to this reading that talks about multi-factor models. So this really builds on the curriculum that you experienced at level 1, but we're going to take it, extend it a little bit further, to refine some of the details, and overall this isn't too difficult in this reading, and we'll finish up with looking at active management and the information ratio, and we'll see that there's lots to be said about that as we go on through portfolio management. So a quick history here in terms of portfolio management. So going all the way back to 1958, Markowitz established his mean variance framework. We sometimes talk about Markowitz efficient diversifiers. Well, the whole idea behind Markowitz was this quantifying the benefit of diversification. So this was where we looked at the correlation between the securities, so that we found that those securities that had a correlation that was less than +1, right? So remember that correlations bounded between -1 and +1. +1 means that they move in lockstep fashion, okay? At least some sort of linear direct transformation between them. And so you can just think of them as moving up and down exactly together. Well, if you have things that are perfectly positively correlated, there's no benefit from diversification. That would be like buying one share of Microsoft stock and then to diversify yourself buying another share of Microsoft stock, right? So there's no diversification benefits there. But if the correlation between the two securities is less than +1, so anything less than +1, then the risk of the portfolio, the two securities together, will be less than the weighted average of the standard deviations of the two individual assets, or however many individual assets you have in the portfolio. So portfolio returns are going to follow this multivariate normal distribution that we've talked about elsewhere in the curriculum, and all of this is going to be based on the idea that we know the expected returns, we know the risk or the variance / standard deviation of the individual securities, and we know the pairwise correlations between them, and that allows us to derive or to develop the Markowitz efficient frontier, also sometimes called the risky asset frontier, and we'll get a look at that in a little while. After Markowitz did his work, what he did not include was the concept of a risk-free asset. So the reason we call Markowitz stuff the efficient frontier that we developed under Markowitz the risky asset efficient frontier is because there is no risk-free asset. So what Sharp, Lintner, Mawson, Traynor all did simultaneously in the early 60s was to take this mean variance framework and add the idea of a risk-free rate. So we're going to have the assets return is based on a risk-free rate, and then what we're going to talk about as a priced risk. So there's multiple sources of risk when we look at any asset. Well, any asset other than the risk-free asset, I suppose. But there's multiple sources of risk. But is that risk priced? And the idea is that if you have stock-specific, unsystematic risk, it can be costlessly diversified away. So by any mutual fund, they're invested in 700 different assets. Well, if it can be diversified away, it is diversified away. So if we have unsystematic or stock-specific risk, that is not going to be priced, which means it's not going to impact the return on the security. On the other hand, we have systematic factors, or a systematic factor if you're in Sharp's CAPM world. We have systematic risk, okay, which will be priced. In other words, the more risk, the more of the systematic risk that a security has, the higher will be the expected return. Now, in this particular setting, that is when we're talking about Sharp and the CAPM, which of course was all over the level 1 curriculum, you remember the formula. It's one of the 2 or 3 most used formulas on the curriculum, at least in my opinion. So you've seen that before. We'll see it again here in case you don't remember it, but I can't believe you would have gotten through to portfolio management at level 2 without seeing it so many times that you're sick of it. It is a single factor portfolio. That means there's one factor. That factor is market risk. Okay, and that market risk is going to determine the required rate of return. So it's going to be how much market risk does this security have. And recall that beta in the capital asset pricing model measures an asset's exposure to this single factor, that is the excess return on the market. So that was Sharpe's contribution, and it's attributed commonly to Sharpe, Lintner, Trainer, Mawson. All those people developed it independently but simultaneously back in the early 60s. So this idea of price risk deserves a little bit more attention. So if it's a risk that does not affect many assets, okay, then it can be diversified away. So if you say that we have some firms that are exposed to I don't know, changes in the Latvian economy. Well, that's, if there's only 6 firms that are impacted by that, well, then we hold a well-diversified portfolio. We happen to have those 6 firms, okay, but when the Latvian economy goes south, those 6 firms go down. But okay, we have, a bunch of other firms that have something good that happens just randomly to offset that, right? So because that is a risk, okay, in this case the exposure to the Latvian economy doesn't affect many assets, then it can be diversified away. So when we talk about these pricing models, we're always going to be talking about the risk of the security within the portfolio. If you want to talk about the risk of an individual asset, that would be standard deviation, right? So that's total risk, and that would be impacted by Latvian economy risk, right? So here we're talking about things that are going to impact the risk of a security within a portfolio. And if it's not systematic, okay, then investors should not be rewarded for bearing that risk. And there's lots of evidence that, there's lots of evidence that this statement isn't perfect, right? That the investors may be rewarded for bearing some non-systematic risk. That is, total risk may have some influence on return, but its impact is minor after you account for what we're going to call the priced factors. So if we have risk elements, okay, that is, changes in the market, that would be market risk. That's what Sharpe was focusing on with the capital asset pricing model. Then we have these risks that are going to be called systematic risks or systematic factors, okay, and they are going to be priced because all firms are going to be subject to these systematic risk factors. So investors should earn a return for non-diversifiable risk. So you can think about, if you want to think about market risk, I'm an indexer, right? So a big portion of my portfolio is indexed. So I own thousands of securities given the way that I do it. But in 2008, I still got killed, right? So it's an equity portfolio. Well, if all stocks go down together, okay, that's market risk. Well, I was exposed to market risk in a big way. I was exposed to market risk and I got my head handed to me, right? That would be a systematic factor. You can't diversify that away. Now, you can take more or less of it, right? So I could invest in companies that aren't as exposed to changes in the market, but to whatever extent I am exposed to that risk, I can't get rid of it. That's non-diversifiable, and that should be priced. And all we're saying when we say it should be priced is we're saying it should impact return on the security. So when we calculate the expected return, we know what the risk factors are. We ought to be able to come up with some idea of what expected return should be. All right, so the arbitrage pricing theory. Now, you can see this as it's probably, the CAPM is a single factor model, right? So there's this one risk factor, that's market risk, and it could be viewed as a very specialized case of the arbitrage pricing theory. I would view them as sort of competitors. A single factor model, we really only have one of those, it's the CAPM. There's some variance in the way we use it, that type of thing, but we can think of that as the single factor model versus these multi-factor models. So we tried for several decades to convince ourselves that the CAPM was right. Ross in '76 developed this APT, and he had to make very few assumptions to do it. So all it says is the expected return is a linear function of a set of factors capturing systematic risks. The problem with it is that the identity of those risks, or even the number of those risks, number of factors, is not identified in the theory. So at least with CAPM, we know what the priced risk is. With the APT and the models that stem from it, well, we're sort of left guessing about what those factors are. Of course, we have some people that have identified who claim to have identified, and I would just say that maybe they have identified at least some of the price factors, right? So we're going to have multiple price factors, so it's really going to be a lot like the CAPM. It's just that instead of having one sensitivity and one factor that we multiply together to get a risk premium, we're going to have multiple sensitivities and factors that we multiply together, and we're going to have multiple sources of risk or priced elements that we are going to be accounting for. So if we looked at this and we said, well, if you take just the first part of it here, right? So and we're looking at the APT still. It's just describing this equilibrium rate relationship. Equilibrium means after all the arbitrage has forced the values of the assets to be equal to their fair value or intrinsic values. So we have this equilibrium relationship in a well-diversified portfolio. Well, if we look just at the first part of it, okay, that I've already outlined here, well, that is the capital asset pricing model, as long as we let this factor, okay, this first risk factor be the excess return on the market. So if that's RM minus RF, excess return on the market, then the beta would be the sensitivity of this asset to the return on the market. We would multiply those two things together. So expected return on the excess return on the market is 8%. The beta is 1.5, so that would be 12. We add in the risk-free rate. That would be the solution under the capital asset pricing model. The only difference here, and for testing purposes, one of the really big things to know is that you just don't need to be surprised by this. It's easy. If you have to operationalize this on the exam, it's easy because they're going to have to give us the sensitivities and the factors. All we're saying now is that, look, we have one factor. That could be market risk. Then we could have another factor, right? Another factor and another sensitivity, another factor and another sensitivity. And we can have as many of these as we think are priced, right? And all we have to do is multiply a factor times sensitivity, and then do that for all of the factors, and then add them together and add in the risk-free rate. So it's just like the capital asset pricing model, only we've got a few more calculations to make on the end, but for testing purposes, there's nothing here that is operationally difficult. All right, so we just have a multi-factor model, which is, of course, the in the title of this particular reading. So the CAPM makes a lot of assumptions. The assumptions are, really way out there. That homogeneous expectations. That means you and I see the world the same way. We all have the same planning period. We have quadratic utility functions. Okay, the market portfolio exists and is known. All those types of things that go on. And at the end of the day, we end up with a really strong results. Okay, but we made really strong assumptions to get there. Like we alluded to earlier, the APT only makes 3 assumptions. Okay, that returns are derived from this multi-factor process. Okay, that unsystematic risk can and will be diversified away, which is basically the last 2. That unsystematic risk can be diversified away, and that arbitrage opportunities are going to eliminate any mispricing. So we make 3 assumptions here in the APT that seem reasonable, and what we get is this multi-factor model. The problem, of course, is that we don't know what the factors are. And, of course, Roll and Ross in 2001 showed that very little portfolio variance is due to non-systematic factors. So if you take a well-diversified portfolio and you account for what they have identified as the factors, okay, then the residual variance in the portfolio is fairly low. All right? So let's think about this arbitrage opportunity notion for just a moment to make sure we understand what the APT is saying. So remember, an arbitrage is a free lunch. That means it's a portfolio with no investment and positive returns. So I'm not going to invest any of my money, but I'm still going to earn some return. Well, it's a money machine, right? It's a free lunch. So where does that lie within this example? So we're looking for something that's risk-free, no investment, positive return. Well, what we see here is that we have 3 portfolios, cleverly named A, B, and C. So we have expected returns and factor sensitivities. So you can, we have the factor sensitivities, and this is a single factor model. Let's assume for this example that that's the appropriate model. So you can think of those as betas from the capital asset pricing model. All right? So we've got portfolio A has an expected return of 10%, factor sensitivity of 1. Okay? Portfolio B, 20%, factor sensitivity of 2. Portfolio C, 13%, and a factor sensitivity of 1.5. Where does the arbitrage opportunity come in? Well, remember that when we talk about portfolios, these factor sensitivities, these betas, okay, are just a linear combination of the of the betas of the individual assets. So what we could do is we could take portfolio A and B and we could combine it. Let's put 50% of our money in A and 50% of our money in B. Well, what's going to happen if we do that? Well, expected return, of course, is just a linear combination of the individual assets. So we're going to come over here and say, well, we got 50% of our money in an asset that has 10% return, 50% and 20% return. So that's going to give us a portfolio that has a 15% return. Okay, and what about risk? Okay, well, risk is going to do the same thing. Now, you can't do this with standard deviations, right? But you can do it with these factor sensitivities. The risk of an equally weighted A-B portfolio is going to be 1.5, right? So what we're going to do is we're going to create a fourth portfolio, one that has risk or factor sensitivity of 1.5, okay, and we're going to have an expected return on the portfolio of 15%. Well, hopefully you can see the problem with that, right? So you have portfolio C down there, has the same risk as the new portfolio that we're creating, 1.5, but it has a lower return. So the equally weighted portfolio between A and B, so that's our new portfolio D. You can see here the math behind the expected return on the portfolio is 15%. Factor sensitivity of the portfolio is 1.5. So what do we want to do? Well, we're going to say, look, we have these two portfolios that have identical risks. Okay? The factor sensitivity of the portfolio is 1.5, but different returns. So what we're going to do is we're going to go long portfolio D. So we're going to invest in portfolio D. We're going to earn 15% there. And then we're going to fund that by shorting portfolio C. So we're going to sell portfolio C, sell $1,000 worth of that, bring in the money, take that $1,000, invest in portfolio D. So we're short portfolio C. We're going to lose 13% there. But we're long portfolio B. We're going to make 15% there. We end up with this 2% return. So portfolio C doesn't offer sufficient return for its risk, so the market would not be in equilibrium, but if everybody's selling portfolio C, then that's going to drive down its value, which drives up its return. If everyone's buying A and B, then you're going to have this arbitrage is going to be a self-eliminating circumstance where it's going to drive up the value of the portfolio D, down the value of portfolio C until everything is back in equilibrium. And we're assuming that this does not exist when we look at these factor models, either multi or single factor models. This process has already occurred in order to force things to be properly priced or priced correct in equilibrium so that these free lunches don't exist. All right? All right, so that's sort of a preamble to the multi-factor models. Let's dig in just a little bit and see what the manifestation of a couple of these, and then we're going to kind of break them out and operationalize at least a little bit as we progress through this reading. So probably the most famous of the multi-factor models is the Fama-French model, right? So the Fama-French three-factor model, it is very influential. It certainly has some issues surrounding it, but they don't talk about those anywhere in the curriculum. So this is the Fama-French model, and it's a three-factor model. Notice that the first factor is simply market risk, the return on the market index minus the risk-free rate. That is exactly what we would do if we were looking at the capital asset pricing model. So the first factor in the Fama-French model is market risk. So the return on the market index minus the risk-free rate, okay, that is the excess return on the market. Okay, we've got an estimate of what that is, and for any particular security, we can estimate its sensitivity to that based on regression analysis. Okay, but in the Fama-French, there's three factors, so that's the first one. There's two others, obviously. Okay, it's small minus big, so the return on small securities minus the return on big securities. So it's a market capitalization thing. So there's some times when small firms outperform, other times when big firms outperform, and you can't diversify that risk away is what this is saying. So the small minus big would represent a priced factor, okay? And the normal difference between this is 3. Small return, what this is literally saying, and not that this is historically accurate, but for our example, what that 3% is saying is that small firms have had higher returns than big firms, right? And our sensitivity to that is going to be 0.4, and then high minus low, that is high book to market minus low book to market. And in this case, high book to market is, you can think of those as value firms, so don't be confused by that. We've talked about elsewhere in the curriculum here at level 2 and also mentioned in level 1, we looked at the price to book ratio, right? Well, if we turn that on its head, we get a book to price ratio, right? Well, this is book and market, so they're using market for price, and you can think of it as the book value of equity divided by the market capitalization of the firm. You could also do book value per share divided by the market price per share. Either one of those are going to get you the same thing. So, but the point here is, if you have a high book to market, so let's not think about this one for a moment. If you have a high book value relative to your market, well, what does that say? Well, your book value is big relative to the market value. Well, that's a firm that's been beaten up, right? You can think of that as a value firm. Okay? Whereas low book to market says your book value is small compared to your market value. Well, that's going to be a high price to book firm. Maybe that's going to be a high flying firm, if you want to think of it that way, a growth firm maybe. Anyway, so we're not going to talk about growth or value yet, but that's the intuition to lever this HML, high minus low, high book to market minus low book to market, and it's just another risk factor. So 2%, and then we're going to multiply by the sensitivity here, and notice that in this case the sensitivity is negative, so it's minus 0.8. What do we do with this? Well, there's nothing here that's going to be difficult, right? So all we're going to do is we're going to plug in, we're going to say the return on this particular security is going to be equal to the risk-free rate, which we're given of 3%. Then we're going to take each risk premium and multiply it by its sensitivity. So 5 times 1.1, so that's going to be 5.5. And then we're going to take 3 times 0.4, and we're going to take 2, that's supposed to be a multiplication sign, 2 times minus 0.8, and we're going to plug in, and that's going to give us the expected return on the security. So here's the risk-free rate, here is the risk premium associated with the market index, okay, here is the risk premium associated with the size factor, and here is the risk premium associated with book to market, and we get an expected return for the security of 8.1%. So easy to operationalize, and I don't think there's any big tricks here on the exam. One is to realize that operationalizing is easy. There's some follow-on to this that you're going to have some intuition behind it, but actually implementing this, were you asked to do so on the exam, no big deal. It's just risk premium times sensitivity over however many they give you. There could be 10. They won't give you 10 on the exam, but and then we're going to add them all together and then add in the risk-free rate. All right? So, no issues there. All right, so let's now take this and generalize. So the Fama-French was one particular multi-factor model, and there's others in the curriculum. We talk a lot about the Carhart model as well. We'll see that later. It adds basically a momentum factor. I mean, there's other models that add a liquidity factor, those types of things. So there are a number of competing multi-factor models. But we can break these down into different classifications. So we're going to take this APT and say, okay, you've got all these competitors out there to be arbitrage pricing models, APM or APT, and how can we classify those? Well, what we're going to see is that there's 3 ways to do that. The first is going to be macroeconomic factor models. Okay, well, if it says macroeconomic factors, what do you think is going to be influencing it? Well, it's going to be macro factors, right? So it's going to be interest rates, inflation, business cycle, that sort of stuff. But you have to remember that for the macro models, it's not the value of the factor, right? It's not the level of the factor. So if we're talking about business cycle and we're using that with GDP, well, if we expect GDP growth to be 2% and GDP growth is 2%, well, that's already priced in. The market is smart, right? You're not the only person that knows what the current level of GDP growth is. What we're going to be looking at is surprises. That is, changes. What if interest rates unexpectedly jump up, okay? Or unexpectedly jump down, or inflation raises its ugly head, or, credit spreads, contract, or whatever it happens to be. Those are all macro factors, and we're not looking at the level, but we're looking at changes, because whatever the level is, or whatever was anticipated by the market, would already be priced. Okay, the second one, and probably the most interesting from our point of view as CFA test takers, are the fundamental factor models. So this is where we're actually going to use the attributes of the individual asset. Here we're talking about it in terms of stocks. The attributes of the stock or the company that would be important in explaining the cross-sectional difference in returns. So that would be things like book to market, the market capitalization, the size factor that we just talked about, and then price to earnings ratio, leverage, all those things. But those are going to be attributes that pertain to that particular security. So fundamental factors look at they're also called microfactor models, right? So macro deals with macroeconomic variables. Micro deals with firm-specific factors or attributes. Book to market, market capitalization, PE ratio, those types of things. We also have a third category. These are statistical factor models. This is not the place to get bogged down. There's two different types. There's principal components and factor analysis models. And all these are is an algorithm in a computer that says, look, let's take whatever the underlying elemental data is. So think of that as firms. And we're going to look at the change through time, and we're going to let the computer pick and choose which things it thinks are going to be important. So, well, not it thinks, but it's going to calculate which things are most important. And in a principal component, it's going to come up with factors that best represent the variances. And for factor analysis, the covariances. I don't think either of those things are particularly important. The point here is, at the end of the day, we're going to end up with a multi-factor model. But those factors, okay, and it's going to look the same. It's going to be factors times sensitivities, and there could be multiple factors. But the factors are going to be almost unintelligible, uninterpretable combinations of, if we're using microdata, it could be the firm's beta, and then some PE ratio, and then 0.2 times leverage, and all this sort of thing that are all crammed into these factors, and they're not very interpretable, and hence there's very little intuition here. So we know what a statistical factor model is, but this is attaching any economic meaning to the factors is either difficult or impossible, so I don't think there's a whole lot to say about this, and I don't think it's particularly testable in a multiple choice framework. All right? So if we're looking at macroeconomic factor models, well, this is what it's going to look like. And the hard thing for most people to swallow when they first look at this is the very first variable after the equal sign here, right? So this is the expected return. Okay? It's not the risk-free rate. Okay, and it's not anything else. Okay, it is the ex-ante return. So it would be the expected return on the security. And for our purposes, it's best just to think of it as, okay, this is something that comes out of a different model. So we have some sort of model that would tell us what the expected return is, and that's if there are no macroeconomic surprises. You could also think of it as just starting from a market return, okay, something along those lines. It depends on whatever you build in here is going to impact the calculation of the rest, the sensitivities and the factors, but we're not going to be doing that, so you don't have to worry about it. So it's just going to start with the expected return on the security, and then it's going to adjust based on surprises. So if we're looking at a two-factor macroeconomic model, we start with the expected return, okay, and then we're going to think, well, what about changes in the business cycle? So GDP jumps up or it jumps down, we go into a boom, we go into a trough. Okay, well, we could measure the sensitivity to changes in GDP growth, and then we could look at how much GDP actually changed. So GDP surprises, okay, that's actual minus this consensus predicted growth. Well, that's going to be the change. Okay, and then this is going to be the sensitivity. So these two things together, the product of that is simply going to be the risk premium. Okay, and then we can also have another factor. That's going to be changes in interest rates. So what about the sensitivity of this firm to changes in interest rates times the change in interest rates? Okay, well, that would be the factor times the sensitivity. And then we have this other thing on the end. Okay, this is the company-specific surprise return. So if we were looking at this as wanting to understand the return on Microsoft last year, well, then starting before last year, we could have estimated our model. Okay, we would have our factors and sensitivities. We could look last year at the change in GDP times Microsoft sensitivity, change in interest rates times Microsoft sensitivity to that. Well, that's still not going to equal the return, so there's still going to be this firm-specific part on the end. Now, in my world, it doesn't make much sense to plug in a value for that because it's supposed to have an expected value of 0. But nonetheless, I've read or seen exam questions where firm-specific return is 2.2% or something, in which case you would just plug it in, and then you would have explained 100% of the return. So, but I don't know that that's great questions, but then I'm not the one that they asked if they should write those. So anyway, but the point here is, look, it's going to be an expected return. Think of that as coming from somewhere else. Then a risk premium, and then this part that's not explained. You're still not going to have perfect explanation of the returns because there's still going to be company-specific things that happen, right? So they zig when they should have zagged. All right, let's think about fundamental factor models. Okay, it's easier if you call them micro models, right? Because we got macro and micro, and that very clearly delineates them. But nonetheless, the common term is not a micro factor model, but a fundamental model. A fundamental model just means we're using these firm-specific attributes. Okay, well, in this case, the factors are returns, not surprises. So if one of the things we're going to use in our model is PE ratio, Okay, well, we're going to take the firm's PE ratio and we're going to plug that into the model. It's not the change in PE. So it's going to say is, look, here's the PE. What is the beta associated with that in this cross-section of returns? Then that's going to tell us what the sensitivity is, and that's where we're going to get the model from. Now, there's actually a caveat to that I need to talk about in just a second, but nonetheless, it's not surprises. Macroeconomic surprises. Here, we're just looking at the level of the factor. The intercept is not identified. It's not going to be equal to some expected return. Okay, the factor sensitivities here, okay, are going to be standardized values of the individual attributes. And this is the part that confuses people, I think. So to be real careful about that. So if we have this firm that has a PE ratio equal to 10, right? And we have the average PE ratio for firms in our sample are going to be equal to, we'll say, 20, right? Well, then we know where we stand relative to the average, but we're going to standardize this just like we would with a z-score. So we're going to take the attribute of 10, we're going to subtract off the mean of 20, and then we're going to divide by the standard deviation of the PE ratios, and that's going to give us the equivalent of a z-score. So if this comes out to equal, minus 1.5, what that means is that this PE ratio of 10 is 1.5 standard deviations below the mean PE ratio for this sample. All right? So just like a z-score, we looked at those at level 1 in some detail. So it's just a z-score. So it says we have the PE for this company. Okay, this is evidently a low PE firm, right? Because its PE ratio is 1.5 standard deviations below the mean. So if we did all this again, and we changed our numbers here so that so forget this example. So if we did all of our calculation and we said, okay, let's take the PE for the firm, and we're going to subtract off the average PE, right? Put the bar up there for average, divide by the standard deviation of the PE ratio, and that comes out to be 0. What is that telling me? Well, that's telling me that this firm has the average PE ratio in the sample, right? So if you have a PE ratio of 0, if you have a standardized score of 0, then you are the mean. Okay, if it's negative, well, that's telling you how many standard deviations below the mean you happen to be. If it's positive, that's how many standard deviations above the mean you happen to be, right? So here, and this is the part that's going to, sort of weirds people out, okay? The sensitivity here is actually going to be this standardized value. So if you're new to quant method stuff, then you spend a lot of time getting on top of regression. You said, okay, if I want to understand changes in housing starts, then I have an intercept and I have changes in interest rates. So I'm explaining the changes in housing starts with changes in interest rates, okay, and I come up with this sensitivity out of the regression equation. Right? So that's the whole point of a regression, is to estimate that sensitivity, and that's what we did all the t-tests on, all that sort of stuff. So I had lots of fun with that. Okay, but here what we're saying is the sensitivity is going to be where in this distribution of attributes, in other words, in the distribution of PEs among this firms in this sample, where does this firm fall? Is it at the mean? Is it well below the mean? Well above the mean? Well, that's going to tell us how far away it is from the mean, and then the returns are the factors. So we're going to, and where do they come from? Those come from a separate regression where we regressed returns against standardized PE ratios, okay, and we ended up with the size of the factor. So a change in that factor, the standardized PE of 1, well, if that's equal to 4%, well, that would be the factor in that equation. All right? So the difference here between micro and macro models, okay, the macro model is what you think it is, right? If you're thinking regression, you have a factor, that's the change in GDP, and then you have a sensitivity that you estimate with a regression coefficient, right? Here, the factors are I guess the change in return for a 1-unit change in the attribute, and then the sensitivity is where in that distribution of attributes do we fall. All right? So it is a little bit different, and if you wanted to come up with one question out of multi-factor models, that might be a good one to understand that the sensitivity is where the firm lies in this distribution of PE ratios, all right? And then the factor is just, well, how big an impact does being above or below the mean have on returns for firms in the sample. So, and of course, the reason we do this, all the scaling, is so that it's unitless, right? So scaling allows all factor sensitivities to be interpreted similarly, regardless of units of measure. So if we had size, we could be using market cap, we could use the log of market cap, or anything else, and we're just going to take it and create, I think of them as Z statistics, all right? So anyway, so we're going to come up with these standardized variables. So to compare and contrast. Nope, sorry, not comparing and contrasting yet. Coming up soon, though. So another fundamental factor model, okay, the return here is going to be equal to, in this case, whatever our A is, it's going to be the intercept. It doesn't have any particular intuitive measure or intuition, I guess, intuitive intuition. Doesn't have, there's no specific intuition behind it. Okay? And then we're going to have sensitivities times factors. Sensitivities times factors for however many factors we've identified, just like we've had before. The difference here between this and the macro model is that the sensitivity is just the standardized score. So where in this distribution of PE ratios does the company fall? The factor is the influence of having a high or a low PE ratio. Same with size, right? So, the betas here are going to be the standardized scores for our attributes, in this case PE and size, and the returns are going to be the return difference between a high and a low PE firm. So we're just going to take returns and regress them against PE ratios in order to get the factors. So the factors are going to have to be estimated separately is what that's telling us. So now, thinking of comparing and contrasting the two, okay, well, a macro model, of course, has to be estimated over time because we need changes in macro variables. And the change doesn't happen at time 0, right? So the change says we come in at 2% GDP growth and it changes to 3. Well, that was the surprise, so it has to be time series. The fundamental factor models are going to be cross-sectional. Remember, the intercepts have different interpretations, so it is an expected return in the macro model. It's not identified or specified in the fundamental factor models. But what I think I would focus on from this slide, okay, is the middle elements here. The factor sensitivities for a macro model, well, how sensitive is this firm to a change in interest rates? Well, that comes out of a regression, right? So we get our factor sensitivities times our factor sensitivities from a regression model. And then the factors are, well, what is the change, right? And then for the fundamental factor models, we use regression to tell us how a high versus a low PE firm behaves. And the sensitivity is the standardized attribute, right, which is what we've been talking about for the last several minutes, right? So anyway, so macro versus fundamental models, or macro versus micro models, and focusing on the difference between the calculation or where the sensitivity comes from. Macro model out of regression, fundamental model as standardized attribute, all right? So multi-factor models and return attribution here. So if we're looking at fundamental factor models, okay, we can use them to decompose the sources of an asset manager's return relative to the benchmark. So if this manager beat the benchmark, why did he beat the benchmark? Well, maybe it's because he had higher PE firms. So we can decompose the manager's returns via one of these models. Okay, these models are, easily understood. Easily, maybe if you're struggling with this, that may not sound easily, but it's going to come, so it'll get there eventually. And they're easy to communicate. Oh, here's the bets we're taking, right? So we think high PE firms are going to do well because we're coming out of recession, so we're going to load up on those firms so we can communicate to our investors what we're doing. So we can express investment style choices. Well, again, we could be a small cap or a large cap firm, that type of thing. Easy to express what's going on. And the fundamental factor models, microfactor models, same thing, are the most commonly used. They're more commonly used than either macro or statistical factor models. And again, I wouldn't worry too much about statistical factor models other than knowing what they are. So anyway, so that's the idea behind these factors. So let's change gears for a minute. So here we're going to start looking at active return and active risk. And this is going to be something that we can develop a lot as we go through the curriculum. But we're going to introduce the idea here. So active return is just the difference in the return between the portfolio and the benchmark. So if you happen to be a finance professor and you are, and the market's raging, right? So, it's a great year in the market. Well, you have people that love to come up to you and say, hey, I earned 14% on my portfolio last year, because they're picking individual stocks. Am I smart or what? Well, okay, so you earned 14%, right? But the market over the last 12 months has earned 18%. Well, what that would tell me is that you had an alpha of -4, assuming you were taking the same systematic risk, which we'll talk about later. But nonetheless, so the active return is not the return on the portfolio or the excess return, which is the difference between the return on the portfolio and the risk-free rate, but it is the difference between the portfolio, okay, what your portfolio earned over a particular period, and what the benchmark earned. So you can think of this as managing a portfolio relative to a benchmark. So my benchmark is the S&P 500. That means you're looking at large cap, primarily U.S. domiciled securities. And and the way we evaluate active managers is their ability to generate positive active return, right? We might also call this alpha. Right? So on the other hand, we could also have this idea of active risk. Right? Well, active risks is an attempt to think about, well, were we lucky, okay, or did we actually do something that might indicate skill? So if we have a firm or a management team that earns, a 1% alpha in the first year, and a 1% alpha in the second year, and a 1% alpha in the third year, those are supposed to be commas, okay, well, they've earned 1% a year, their standard deviation is equal to 0, right? On the other hand, we could have a firm that earned -1, okay, and then earned, 2 and 1, right? That's all come out the same. No, I have to earn 2, right? So anyway, whatever it happens to be, you'd think I'd be able to add those up and divide. But nonetheless, this variation in return, okay, well, this firm, okay, this manager has variation in their alpha. Well, what we're trying to capture is there's a big difference between a firm that returns 2% alpha every year and a firm that has, 5% one year and, -3% and 2% and -7% and 9%. Okay, we're trying to distinguish between luck and skill. So when we talk about active risk, we're going to measure what is the standard deviation of their active return. So this is all this is standard deviation calculation. Been looking at this since level 1. So it's going to we're going to take this and say, okay, well, what was your active return? We're going to take that, we're going to square it, and we're going to divide by n-1 because we're dealing with samples. So this, the RP minus RB in parentheses here, I would write that as a subscript, right? So, and the way you may see this later on is a sigma for standard deviation, and then a sub A, right? That's for the active management portion of the portfolio. So we're not looking at total variability here. The total portfolio could be going, all over the place. We're just looking at the variation in active return here, all right? So we have active return, we have active risk, and we can put the two together to come up with this little gem. That is the information ratio. So this is active return per unit of active risk. And of course, the higher the information ratio, what you want is a manager that can deliver, high active return, 5%, and have very low standard deviation. Okay, so that's going to be, we'll take 10% here, standard deviation, and that's going to give us an information ratio of 0.5, right? So we're trying to get an idea of the manager's skill, and we're going to investigate and decompose this a lot later on. But the notion here is that the information ratio is telling us something about the manager's skill in the investment process. Right? So the information ratio turns out something that is highly testable, and we'll see this elsewhere in the curriculum as well. Okay, my slide to advance. So what we can do now is let's break down this active return a little bit, and as sort of a starting point for thinking about it. So active return, well, active return can come from two sources. Okay, it can come from one thing, which is called factor returns. So let's think of a portfolio that has is composed of different sectors. So it's sector A and sector B, transportation and materials, or whatever it happens to be, right? Okay, so well, if we look at a benchmark that has 50% in one and 50% in the other, well, that would be the benchmark weighting, right? Well, factor return says, look, as the active manager, I'm going to put 60% on sector A and only 40% on sector B. So I'm changing the way I weight the portfolio between the different sectors. Now, you could also think of it as equity and fixed income or something like that. So factor returns have to do with factor tilts, right? I'm going to overweight transportation, underweight something else. On the other hand, if we look within the factors, we can also see security selection impact. So within transportation, well, maybe we have, we're going to overweight Delta and underweight American Airlines, right? So, and the question is, are we doing that well, and are we earning some alpha from doing it? Are we earning positive returns, or are we earning active return, return above the benchmark? So there's two ways to earn active return. You can either have factor tilts, okay, that is, I'm going to do sector rotation strategies, or I can have individual security selection within the sectors, and we can break that out. So the way we can take this active return and decompose it is we can calculate the factor returns, right? So the factor returns is simply going to be the portfolio beta times the benchmark beta, and then it's going to be times the factor returns. I lost my mind there for a moment. So we're going to be looking at how we are changing the weights here for our factor tilts, right? So we're going to be tilting one way or the other. And then if we know the active return, we know this part, okay? That is, we know what's going on with the factors. Then we can calculate as a residual the security selection. So we can take the total active return. We beat the benchmark by 2%. Okay, 1.5% comes from factor returns. The other 0.5% then has to come from security selection. So we're just breaking this down. You can think of this as return attribution, but it's active return attribution analysis. Okay, so this is return. We can calculate factor, and then security selection will be the residual, as we explain active return. We can also decompose active risk. So excuse me, active risk squared. Don't forget the square, right? So active risk squared is going to be equal to active factor risk plus active specific risk. Once again, these are going to be our factor tilts. This is going to be specific security selection. Okay, so the active risk attributable to stock selection, right? So that's overweighting Delta, underweighting American, as opposed to overweighting transportation and underweighting materials or whatever it happens to be. Well, in this case, we can calculate the active specific risk. Okay, so what portion of our total active risk, or our active risk squared, what portion of that is coming from specific risk? Well, that's just going to be the weights in our portfolio minus the benchmark weights squared times this thing, the residual risk of the ith asset, which we can calculate. It's actually elsewhere in the curriculum. I don't think it's something that you have to worry about here, and the formula is not included in the reading, so let's not drag that out. Okay, but nonetheless, this gives us the ability to calculate the active specific risk. So when we were talking about return on the last slide, we calculated factor return, and then we got specific return as a residual. Well, here we do just the opposite. We're going to come up with active specific risk, and then we're going to get factor risk as the residual. So if you want to know what portion of the active risk comes from stock selection, which comes from factor tilts, well, we can break that out as well with this little metric. All right? So factor models in portfolio construction. Hey, well, remember, passive management here just means that we're using multi-factor models to ensure that the portfolio replicates the index's factor exposures. So what that says is, look, if I want to manage a portfolio relative to the Wilshire 5000, okay, there's 5,000 securities in there roughly. Do I have to go out and buy all 5,000 of those securities? Do I have to make sure that my weighting scheme conforms to their weighting scheme? Well, if I know the factors that drive return on the Wilshire, well, then I could create a portfolio potentially involving many fewer than 5,000 securities, lower transaction costs, all that sort of stuff, that would replicate all the factors and therefore have the same returns. So I can put that in place, and then I can just have passive management along those lines, which of course we're talking about this in the context of equity, but that's the only way to replicate a bond index, right? I mean, you can't buy the bonds because they end up in somebody's long-term portfolio, and they are thinly traded if they trade at all. So you have to essentially think of these exposures and replication of exposures in a fixed income portfolio. Okay, we can also use these multi-factor models for active management, which is really the star of the show when we talk about this. So we can rely on these to help us predict alpha generated by our active bets, okay, on some factors, and then get rid of other factors. So if you think that because we're going to be in an economic recovery that you want to take lots of market risk, well, you can take lots of market risk, and then you can get rid of size exposure or PE exposure or anything else by putting together this portfolio called a factor portfolio that really loads on one of what you think are the priced factors. So active managers can say, look, we're betting on this. So we're betting on high PE firms outperforming low PE firms, something along those lines. And then you can if you don't want to take the rest of the risks, well, then you can neutralize those by looking at other factor portfolios. But the point here is, in simple terms, that if you're an active manager, you should know what bets you're taking, you should be strategic about it, and then you can predict alpha based on your bets, okay, using these multi-factor portfolios. And there's also these rules-based algorithmic active management. I sort of lumped the enhanced indexers in here, but what that would say is that we have some rules that lead us to factor tilt. So when, factor X becomes so much bigger than factor Y, then we change weighting, those types of things. It's a low-cost system, so you don't have to make these decisions every day in real time. As things deviate from means potentially, whatever our algorithm is, it's algorithm-driven, then we will change our weightings, and it's a little more simple. And you can if you do it correctly, of course, you can capture some alpha, and that's, of course, the whole point of this. So strategic portfolio decisions, again, I think we've been talking about this on the last slide as well, but what we're doing is we're saying that investors should ask two questions. What kind of risk do I have a competitive advantage in bearing versus what kind of risk do I have a comparative disadvantage? And a great example is here on the slide for pension funds. Well, pension funds have very long investment horizons, okay, and so they're not really exposed to liquidity risk. So if the value of liquidity, however you want to measure that in the market, changes, well, we're not really worried about that as a pension fund because, if value of the asset falls, we're not worried about having to sell in the short run because we have very long-term liabilities. This asset that we're managing, it has this very long time horizon. Okay? But we are very sensitive to horizon risk. So what we're going to do is know what our risks are that are important to us, which are not important, and we're going to focus on managing those that are important. So I'm somebody who works for a living, so I'm exposed potentially to business cycle risk. Well, here's what you don't want to have happen. You don't want to have the world go to hell in a handbasket, and i.e. you lose your job, at the same time your portfolio crashes, right? So in that case, you're really exposed to business cycle risk because your human capital is exposed and your financial capital. So what you may want is something that has, in your financial portfolio, something that would have counter-cyclical elements so that when you did lose your job, well, the value of your portfolio went up, so at least you and your children didn't starve to death. So we can think about what types of risk can we bear, what kinds of risk are we really sensitive to that would lead to bad outcomes, and we can manage those via these multi-factor portfolios. So the CAPM leaves the investor with a choice between the risk-free rate and the market portfolio, right? So everyone's going to invest in the same thing. It's going to be this market portfolio, the risk-free asset, and we get to choose where and there we want to be. That's what's going on with the CAPM. With multi-factor models, we get a better description of portfolio characteristics. Well, we're sensitive to PE, or we have a portfolio that is betting that large firms are going to outperform. Okay, we can provide better diversification risk management potential because if you're really sensitive to one thing, you don't want to load up on that risk, right? So fundamentally, your economic characteristics are sensitive to some risk factor out there. You don't want to load up on that risk because that's doubling down, or at least unless you have a really strong prior about the way that's going to resolve in the coming period. So we can get better diversification risk management by looking at multi-factor models, and we can provide more efficient portfolios if asset returns are better described. So if we understand what's going on with the returns on our portfolio, then we're able to build a better portfolio in the first place, is all that's saying. So keys to the exam here. Well, of course, we want to know what's going on with the APT, these arbitrage portfolios, or these arbitrage portfolios, that is, the portfolios that assume that arbitrage is getting rid of inefficiencies, right? So make sure that we understand the arbitrage pricing theory. I think a big focus here is micro versus fundamental models. Okay, you probably want to focus on the fundamental models, understand where they come from, but you certainly need to be able to compare and contrast. Okay, the idea of decomposition of active risk and active return, I think, is very appealing. It's going to be treated elsewhere. So this is something you want to make sure you have a handle on. And then the use of these multi-factor models for investment suitability. Well, what should I, as a really good-looking 40-year-old do with my portfolio, given my investment horizon, my sensitivities, those types of things? So we end up with better portfolios if we understand the risks of the risks faced intrinsically by the investor, and then the factors that impact the risk in the portfolio. Well, obviously, we can build a better portfolio to match the needs of the investor.